Welcome to Armberger Smackdown. I'm J. Christoph Armberger. Last week I pointed out an almost invisible fault line that runs through the financial markets. China's $1 trillion in bad debt. So far there is no indication that this is of concern to anyone, or at least of less concern than new US government debt is to the dawn chorus of doomsday croakers that constitute the financial punditry. Both cases in a way illustrate how valid Benjamin Franklin's observation still is that the sound of your hammer at 5 in the morning or 9 at night, heard by a creditor, makes him easy 6 months longer. In growing economies, even bad debt is good debt. Economic growth in China is coming in at over 11%. And since Wall Street and Europe started their subprime shake and bake in July, the Shanghai Stock Exchange has quietly packed on another 1,000 points, doubling its worth over last September. Apparently, China investors and Chinese investors are not buying into the assumption that low-income loan foreclosures in Springfield are anywhere close to putting a dent into the consumption habits of their largest and most important export market. By floating state-owned companies in both Shanghai, Shenzhen, and now Hong Kong, Beijing has managed to soak up unheard-of amounts of liquidity within the system. This partly supplements its endeavors to curb inflation, in addition to the 3 interest rate hikes so far this year. It also had the additional benefit of converting passive savings into active capital, reducing the need for further credit, and redistributing existing debt, including bad debt, from banks to shareholders. It's what's meant by the democratization of capital and the spread of risk. Of course, this method of risk management is not without a hefty price on the national economy. In Shanghai alone, retail investors have pulled between $2 and $4 billion in savings out of their savings accounts each month, converting them into at-risk stock market capital. For the time being, there seems to be no impediment to a further expansion both of the Chinese economy and the Chinese stock markets, especially in view of the 2008 Olympics, less than a year from now. Much like Japan in 1964 and Seoul in 1988, Beijing considers its coming out party as an economic and military superpower. China is spending around $40 billion on its Olympics, building stadiums, airports, expressways, rail links, and infrastructure. That is a smaller percentage of GDP than both Japan and South Korea devoted to their respective Olympics, at least as far as the direct costs are concerned. While China may not be actively propping up economic growth in a targeted fashion until the Olympics are over, the direct costs reported may just be a small part of the actual bill, given the nature of the centralist and political management of Beijing's affairs. Beijing will make sure that its centralist economy runs smoothly throughout the Olympics, providing a continued boost to A shares and H shares throughout next year. After record numbers of companies going public in the last 2 years, there will be a pre-Olympics mini-boom in state-controlled companies going public. If South Korean stocks in 1988 are any guide, this post-Olympic boost would push Shanghai up another 50%, on top of a potential doubling of the index between now and the lighting of the Olympic torch next year. Japan's GDP growth almost halved from 11.2% in 1964 to 5.7% in 1965. Cooling down of economic growth may be just what Beijing is after, but it also would have a dampening effect on new institutional and retail investment in the Chinese markets, making an A-share crash quite more likely after the Olympics. What makes this prospect of a crash so daunting is not necessarily the effect on the small investor. But state-owned companies are at the forefront of punting in the markets, more often than not with money borrowed from the big 4 Chinese banks. Any substantial downturn in these markets would inevitably be followed by a cascade of corporate insolvencies and bankruptcies. Write-offs will result in a flood of negative balance sheets, which in itself will provide incentive for further sell-offs. Simultaneously, there will be a belated tightening of credit that will choke off much-needed access to capital to those companies that are still in business. No doubt there will be heads rolling, literally, as Beijing rediscovers its love for cracking down on corruption when the time is opportune. The global effect of this China syndrome will dwarf everything we have seen in the last 15 years. Not only will global financial institutions, equity funds, and hedge funds, with exposure to Chinese company be hit hard. Given today's preferred fund allocations, there should be a broad-based impact. But Chinese demand for resources and energy is also the main engine of the commodities supercycle. Any drop in demand through even temporary idling of manufacturing facilities through economic or social turmoil will result in dropping demand for oil, metals, coal, energy, and precious metals. That will trigger a domino effect of falling prices. The first to be forced to unlock their stashes to satisfy investor demands will be hedge funds and exchange-traded funds. The sudden availability of long sideline supply will further accelerate dropping commodity prices. Spot prices for bullion, silver, platinum could see consecutive drops of 50% over several days as oil falls back below $40. Other than previous global financial crises, this one will leave no asset unaffected. I'm sorry I cannot give you an exact date for this cataclysmic drop. I believe we will see first signs in late winter or spring of 2009. Until then, you can do worse than hitching a ride on the back of the runaway Olympic bull, as long as you're aware that the ride may come to an abrupt halt a year and a half from now. For TaipanFinancialNews.com, I'm J. Christoph Armbruster.